If you grabbed a random person on the streets of New York or San Francisco and asked them who Ed Thorp was, most likely nobody would know that he was the guy who figured out how to beat casinos and then used the same logic to beat Wall Street. That combination sounds like fiction, but Thorpe's story is real and it's still shaping the way money moves today. He wasn't a gambler in the way Vegas likes to advertise. He was a math professor. He was quiet, but obsessed with how systems break. His students at MIT joked that he could find a formula for anything. However, the joke turned out to be true. In the late 1950s, Ed got interested in blackjack. The game looked simple, but he noticed that the odds shifted slightly, depending on which cards had already been played. He wondered if that edge could be measured, and if someone disciplined enough could turn it into a guaranteed win. He started calculating by hand. Then he borrowed computer time from MIT, back when computers filled entire rooms, and tested every possible sequence of cards. The results proved that if you kept track of what had been played and adjusted your bets accordingly, you could flip the casino's advantage to your own side. And that was revolutionary. Casinos had always believed blackjack was unbeatable. Ed had just shown them they were wrong. When he finally tried his system in a real casino, it worked exactly as the math said it would. He didn't need luck, he needed patience. He placed small bets until the count was in his favor, then raised them. Over time, he won steadily, while everyone around him lost. Casinos didn't appreciate that. They banned him, spread his picture around, and changed the rules of blackjack. But by then, the damage was done. In 1962, he published Beat the Dealer, the first mathematically proven strategy for winning at blackjack. It became a national bestseller. Players treated it like scripture. Casinos had to redesign entire games just to protect themselves. The book made him famous among gamblers, but Thorpe cared more about what the experiment revealed, which was that probability, used correctly, could predict real outcomes. And that meant it could be applied anywhere uncertainty existed. Around this time, he met Claude Shannon, the father of information theory. Shannon loved the idea of quantifying randomness. The two built a small computer hidden in a shoe, designed to predict where a roulette ball would land. It worked well enough that they retired it before anyone caught on. That device is often called the first wearable computer. They weren't chasing money, they were chasing proof. Ed could have stopped there. He could have just been a legend in gambling circles, a professor with a crazy story. But he saw something bigger, markets that looked random but behaved like blackjack. They had structure, patterns, and particularly an exploitable bias. So he moved from casinos to finance. He started trading part-time while still teaching. Most investors then operated on stories, rumors, and hunches. Thorpe came armed with statistics. He looked for tiny pricing errors that others ignored, and designed trades that profited when those errors corrected themselves. That approach later got a name, quantitative investing. At the time, it just looked weird. He tested his ideas in small ways. Options were new back then, and nobody really knew how to price them. He realized you could build mathematical models to determine what each option should be worth, based on the probability of the stock's future price. Years later, the same principles appeared in the famous Black Skulls model, but Thorpe was already trading on them in the 1960s. In 1969, he launched Princeton Newport Partners, one of the first quantitative hedge funds. His team was small, made up of mathematicians, engineers, a few programmers. They used early computers to run thousands of simulations overnight. They didn't need inside information or market gossip. They relied entirely on math and probability, and it worked. The fund produced consistent profits for nearly 20 years, around 15% annualized, with barely any losing quarters, almost unheard of for that era. Other investors started to notice. Warren Buffett once called Thorpe the best mathematician to ever apply himself to investing. Jim Simons, who would later be the most successful hedge fund manager of all time, has mentioned that Thorpe's work was one of the inspirations behind his own approach. And Claude Shannon, his old friend, quietly invested money with him for years. Thorpe wasn't trying to build a massive empire. He was trying to prove that markets, like games, followed rules hidden under noise. If you could identify the structure, you could play rationally while others guessed. In interviews, he explained it simply. People think of the market as random. It's not. It's just complicated. And complexity can be understood. His fund ran smoothly until the late 1980s. Then a partner firm became entangled in a separate insider trading scandal. Thorpe wasn't involved, but the association was enough to shut the fund down. He returned all investor money with profits and walked away. He could have started over easily. Instead, He used his own wealth to manage a small family office, focusing on risk management and philanthropy. He never chased headlines, he just kept studying probability. In the 1990s, while the world was celebrating the dot-com boom, Thorp noticed something strange in the data. There were some returns that were mathematically impossible. He suspected fraud. The fund's name was Bernard L. Madoff Investment Securities. Ed Thorp was one of the first to figure out that Madoff's results couldn't be real. He warned friends and investors to stay away. Most ignored him. Years later, when Madoff's Ponzi scheme collapsed, Thorp's calculations were vindicated. That episode captures who he is, a man who is relentlessly logical. He didn't rely on intuition. He trusted math even when everyone else laughed. And math in his life kept being right. His 2017 memoir, A Man for All Markets, summed it up, how the same probability models that helped him count cards in blackjack also helped him manage billions safely. The book reads more like a quiet masterclass on how to think about uncertainty. He breaks success down into simple principles. 1. Understand the game before you play. 2. Bet small until the odds turn. 3. Protect your bankroll. Always. They sound obvious now because of him. Before Thorp, nobody applied that mindset outside casinos. When you look at modern quantitative trading firms like Citadel, Renaissance Technologies, Two Sigma, you're seeing ideas that trace back to his notebooks. Automated risk management, statistical arbitrage, data-driven decision-making, all extensions of what he built decades earlier. With a chalkboard and a mainframe computer, he also pioneered how academics could actually make money. Before him, finance professors mostly taught theory. He showed that theory, if tested correctly, could generate real returns. That shift transformed how Wall Street recruits talent. Mathematicians and physicists suddenly had a place next to traders. Even today, when Thorp speaks at universities, he's calm and modest. He talks about probability, patience, and compounding. He still answers emails from students. He still tracks anomalies in the markets, just out of curiosity. When people ask how he managed to stay consistent for 60 years, he says something simple. I never tried to get rich quick, I just tried not to lose. He's now in his 90s, still reading math journals, still fascinated by how risk and reward dance together. He doesn't fit the myth of the Wall Street genius shouting on trading floors. He fits the image of a professor quietly solving puzzles in the corner, and somehow the puzzles keep paying off. The irony is that his goal was never money, it was mastery. And mastery, in his world, meant understanding uncertainty deeply enough to survive it. If most gamblers chase luck, Ed Thorp built a system. If most investors chase stories, he built math. That's his legacy. Not the wins themselves, but the idea that any complex system like a card game, a stock market, even a goddamn life can be improved if you learn to measure what others ignore. He was the first gambler to beat Vegas and Wall Street, and he did it by refusing to believe either one was unbeatable.